Hey everyone, and welcome back to the channel. Today, we re-diving deep into one of the most dramatic and devastating financial events in modern history, the Great Depression. And specifically, the catastrophic stock market crash of 1929 that kicked it all off. What really happened? Was it just a single bad day? And how did it spiral so completely out of control? Let's find out. To truly understand the crash, we first need to understand the decade leading up to it, the Roaring Twenties. Imagine a world fresh out of the horrors of World War I. There was this incredible sense of optimism and prosperity, especially in America. New technologies were booming: radios, automobiles, refrigerators. People felt like the good times would never end. And nowhere was this optimism more visible than on the stock market. The stock market in the 1920s wasn't just for the wealthy elite anymore. It became a national obsession. Stories of ordinary people, barbers, teachers, factory workers, getting rich quick were everywhere. You'd hear about someone who bought a stock for a few dollars and sold it a few months later for a fortune. It seemed like easy money, and everyone wanted a piece of the action. The problem was, this created a massive speculative bubble. Stock prices weren't rising because the companies were actually worth that much more. They were rising because people kept buying, expecting prices to go up forever. It was a classic case of hype over substance. A key ingredient in this frenzy was something called buying on margin. So, what is buying on margin? It's essentially taking out a loan to buy stocks. Let's say you wanted to buy $1,000 worth of stock, but you only had $100. A broker would lend you the other $900. As long as the stock price went up, you were golden. You could sell the stock, pay back the loan, and pocket a hefty profit. But what if the stock price went down? You'd still owe the broker that $900, and the $100 you put in would be wiped out. You could end up owing more money than you ever had in the first place. In the 1920s, buying on margin was incredibly easy and widespread, pouring gasoline on the fire of an already overheated market. By the summer of 1929, the market had reached its absolute peak. It had been on an almost uninterrupted upward climb for years. But underneath the surface, the cracks were starting to show. Industrial production was slowing down, construction was in decline, and consumer debt was at an all-time high. A few smart, or perhaps just nervous, investors started to quietly sell off their stocks, sensing that the party was about to end. The market started to feel a bit shaky. There were a few small dips in September and early October, but most people brushed them off as temporary corrections. Then came the week that changed everything. The chaos began on Thursday, October 24th, 1929, a day that would forever be known as Black Thursday. The market opened, and an unprecedented wave of selling began. Panic set in. The ticker tape, which printed stock prices, fell hopelessly behind. People had no idea how much their stocks were actually worth, but they knew they were plummeting. Crowds gathered outside the New York Stock Exchange, their faces filled with fear and disbelief. In a desperate attempt to stop the bleeding, a group of Wall Street's most powerful bankers, led by Richard Whitney, the vice president of the exchange, tried to stage a rescue. They pooled their money and started making very large purchases of major stocks like U.S. Steel. Their goal was to restore confidence, to show everyone that the big players still believed in the market. And for a moment, it seemed to work. The market rallied a bit before the closing bell. The weekend offered a brief, tense calm. People held their breath, hoping the worst was over. But it wasn't. The banker's intervention was like trying to plug a dam with a finger. The underlying fear was too great. When the market opened on Monday, October 28th, the selling resumed with even greater force. This was Black Monday. The market dropped by a staggering 13%. The temporary confidence from the banker's move had completely evaporated. Everyone was rushing for the exits at the same time. And then came the final fatal blow. Tuesday, October 29th, 1929, Black Tuesday. This was the single most devastating day in the market's history. The opening bell was met with a tidal wave of sell orders. There were virtually no buyers. The system completely broke down. 16 million shares were traded, a record that wouldn't be broken for nearly 40 years. By the end of the day, the market had lost another 12%. Billions of dollars in wealth, on paper at least, vanished into thin air. The human cost was immediate and brutal. Stories from that day are heartbreaking. Investors who were millionaires in the morning were destitute by the afternoon. People who had borrowed heavily on margin were not just broke. They were deeply in debt to their brokers. The psychological shock was immense. The dream of easy money and endless prosperity had been violently shattered in a matter of days. Now it's crucial to understand that the stock market crash didn't, by itself, cause the Great Depression. But it was the trigger, the catalyst, that exposed all the underlying weaknesses in the economy. Think of it as the match that lit the fuse of a bomb that had been building for years. The first domino to fall after the crash was the banking system. When the market crashed, people panicked and rushed to their banks to withdraw their savings. This is called a bank run. The problem was, banks didn't just keep everyone's money in a vault. They had invested a lot of that money in the stock market, or loaned it out to people who had. When the market crashed, the bank's investments became worthless. They couldn't sell them to get cash. As people demanded their money, the banks simply ran out. Thousands of banks across the country failed. And when a bank failed, its depositors lost everything. Their life savings gone overnight. With the banks collapsing, credit completely dried up. Businesses couldn't get loans to expand or even to make payroll. People stopped spending money because they were afraid for their jobs or had already lost their savings. This created a vicious downward spiral. As people spent less, businesses sold less. When businesses sold less, they had to lay off workers. When workers were laid off, they had even less money to spend, and the cycle continued, getting worse and worse. Unemployment skyrocketed. By 1933, nearly a quarter of the American workforce was unemployed. That's 1 in every 4 people. Families were evicted from their homes, leading to the rise of shanty towns nicknamed Hoovervilles, a bitter jab at President Herbert Hoover, who many blamed for the crisis. People stood in bread lines for hours just to get a simple meal. Farmers, who were already struggling with debt and falling crop prices, faced environmental disaster with the Dust Bowl. It was a period of immense, widespread suffering that touched every corner of the nation. So what are the big takeaways from the 1929 crash? First, it's a powerful lesson about the dangers of speculative bubbles and herd mentality. When everyone is buying something just because its price is going up, without regard for its actual value, it's a recipe for disaster. Second, it highlighted the risks of excessive leverage and debt, like buying on margin. Borrowing money amplifies both gains and losses, and when the market turns, it can be ruinous. Finally, the crash led to major reforms designed to prevent it from ever happening again. Regulations like the Glass-Steagall Act were passed to separate commercial and investment banking. The Securities and Exchange Commission, or SEC, was created to police the stock market and protect investors from fraud. And the Federal Deposit Insurance Corporation, the FDIC, was established to insure bank deposits, so that if a bank fails, people don't lose their life savings. These are protections we still rely on today. The crash of 1929 and the Great Depression that followed were a defining chapter in American history. They reshaped the nation's economy, its government, and its psyche for generations. It stands as a sobering reminder of how fragile financial systems can be, and how quickly a decade of roaring optimism can turn into a decade of silent despair. Thanks so much for watching. It's a complex topic, and I'd love to hear your thoughts in the comments below. What part of this story do you find most shocking? Let me know. And if you found this video interesting, please hit that like button and subscribe for more deep dives into history. We'll see you in the next one.